In this episode, we take you behind the scenes of the kickoff of our Third Thursdays series on YouTube. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to another week on New Money, New Problems. If you are one of our loyal listeners, I am hoping that you noticed that we did not release an episode last week, and that is the first time in over 3 years that we have not released an episode on Friday on New Money, New Problems without some type of caveat. In transparency, I have been going through a lot. My family's been going through a lot. This ice storm that hit a couple of weeks ago was kind of the icing on top of the you-know-what cake. And we were out of town. So we went on a vacation last week that was greatly needed. I had the opportunity to bring my laptop, record, and edit an episode, and I chose not to. I hope that you will understand and honor that. But we are back in the saddle this week. Before I get into what we're going to cover in this episode, I also want to tell you about a webinar that we're holding next Friday, February 27th at 11 a.m. Central Standard Time. We are holding our Black with Equity webinar. So we have a lot of people in this community who work at jobs that provide equity compensation, restricted stock, incentive and non-qualified stock options, employee stock purchase plans, employee stock ownership programs. And those are things that, if done well, you can leverage them to build wealth in some truly life-altering ways. But if you don't understand how they work, they can be the source of unexpected taxes, over-concentrated stock positions compared to the rest of your portfolio, stress, confusion. We have more people we deal with, at least at the start of our conversations, who are intimidated by their equity compensation than they are encouraged by it. So we wanted to have a webinar where we talk about the ins and outs, things you need to know, and answer your questions. To be clear, you can come even if you're not Black with equity. You can be Latina with equity. You can be white with equity. All are welcome, but we do this Black History Month want to end things off with a focus on the potential opportunity for wealth building that this provides for Black employees in this situation. So if you want to register, we're going to put a link in the show notes, but you can go to newmoneynewproblems.com/Black Equity to register. Now, the purpose of today's video. You are not aware of this if you don't follow our every move on social media, and I'm not offended if you don't. But last night on February 19th, we had our first Third Thursdays. So first Third Thursday. The kickoff of Third Thursdays would be a better way to phrase that. We've been thinking, Danielle, Cena, and I on the team about ways just to, connect in a different way with our community. And we thought about going live on YouTube pretty regularly, at minimum the third Thursday of each month, to answer questions and respond to videos that you all send us of stuff that you see online about financial literacy. Talk about what's real, what's fake, what's valuable, what may be valuable to some people that's just not relevant to your financial situation. So last night we had our kickoff, our demo. We didn't advertise it on the newsletter because I kind of wanted to see how it went first, but we had a good time. I hope you'll enjoy it. Today we're going to give you a teaser or a preview of what we covered. And if you are interested in tuning in live, having a question answered, you can subscribe to us on YouTube at New Money, New Problems and submit your questions. Send it to us in social media. Send us an email on the email address, reply to this message with a question you want us to cover. We'll cover it on Third Thursdays, and if we answer your question specifically, we'll post the replay for you to see where we answered it as well. So this week, we're going to have a quick preview of what we covered. I hope you enjoy this quick snippet of some of the videos that we responded to, and I hope that you'll not just be back here for the next New Money, New Problems podcast next week, but also that you'll check us out on YouTube and consider attending next Friday, 11 a.m. Central Standard Time, the Black with Equity webinar. Details to register are in the show notes. Now, we've done a lot of tax talk. I do want to pull up a video that we were sent about investing, right? I know that you didn't come to a YouTube live to just talk about taxes. And as a financial advisor, we have kind of these different camps of people that we talk with. And it's very rare that we meet someone in the middle, right? It's either someone who has a really complex financial picture and they've kind of graduated from entry level financial advisors, is not the phrase that I want to use, but they've graduated from basic financial advice on budgeting. And now they're in a scenario where they do need someone who is truly integrating some investment knowledge, some tax knowledge, some insurance knowledge, some estate planning knowledge, and they want us to kind of fill in the gaps. The other camp of people that we deal with very regularly are people who are trying to get started. And I have a passion for both, right? But to me, when I have someone who's trying to get started, one of the quickest questions, or I should say the most consistent questions that we get is, how do I start investing, right? Most people don't come to an investment advisor or financial advisor and say, how do I pay down my credit card debt? Although I do get a lot of people asking about student loans. We get more people asking me at a dinner party, what stock are you invested in right now? And I'll tell them, like, that's not my bag. I'm not a person who, keeps up the stock reports and has two screens up monitoring each individual company. I'm more someone who believes in long-term diversification, buy and hold. But a consistent question that I get, a consistent question that you see online is, I'm interested in investing. Where should I start? And because that's a consistent question, there's a lot of financial media, financial videos out there that kind of give you an idea on content like, where should I invest my first $1,000? So you have all of these different content creators who have their version of, where should I invest my first $1,000? I'm going to share one of these videos. I'm going to tell you kind of my perspective on it. It doesn't make it right or wrong. It's just my opinion. And I'll give you my ideas on a person who is getting started investing and where they should focus their efforts. This is another case where this video is taking forever to load. So while it is taking forever to load, I'll say again, if you have any questions that you want us to cover, feel free to type them in the chat. And as soon as this gets loaded up, it looks like that's working now, we are going to share this screen. Give me 1 second. All right.
So this is how I would invest my first $1,000 in 2026. My name's Steve. I'm a former public school teacher, and I grew my account by more than $200,000 in 2025. My first $400 would go into an ETF that tracks the S&P 500, like SPYM, SPY, VOO, or IVV.
All right, let's start right there with, what is an exchange traded fund? What is the S&P 500? Is this something that you should invest in if it's your first $1,000? So an exchange traded fund, we talked about mutual funds in 401ks, and a mutual fund is just a collection or a basket of different stocks or bonds. So you might have a basket that has 50 different stocks, 20 different fixed income instruments. They put them all together, and based on the risk of that portfolio, they tilt towards one way or the other, and you are investing in the entire basket. So you're not investing in each individual company, you're investing in the basket. And as that allocation of companies grows or loses money, you're kind of growing along with them. The thing about a mutual fund is, oftentimes you have like individuals who are managing that fund for you. And as is the case with anything in life, people want to get paid for their work. You also have mutual fund companies that will market that fund to other people. And believe it or not, they charge you a fee called a 12B1 fee, so that they can afford to go market their fund to potential new customers. So there can be some high expense mutual funds that can kind of turn people away from the mutual fund strategy because of how much it's costing to invest. And as a result, it led at some point in time to the creation of exchange traded funds. So exchange traded funds, they offer a portion of the market. So in this case, they're tracking the S&P 500, which I'll share what that is in a second. And there's several differences with an exchange traded fund as compared to a mutual fund. First, because it's likely that they're just tracking a portion of the market instead of a huge team of individuals managing the investment, you're paying less internal expenses to have an exchange traded fund. So you might have a mutual fund that has an internal cost ratio of 0.65, and you might have an exchange traded fund that has a similar level of aggression and is charging you 0.15, right? So less than a fifth, right? So there's a big difference. Another difference between mutual funds and exchange traded funds is with a mutual fund, you can put in an amount that you want to contribute, or you can put in a request to sell that fund, but they don't do intraday transactions with mutual funds. So, for example, if I want to put money into a mutual fund at 11 a.m. on a Friday, that order is not going to get filled until the price has settled for that mutual fund at the end of the trading day. It's not something where I can sell it during the day, buy into it during the day. I have to wait until the market is closed. And as a result, you can sometimes miss opportunities, or conceptually, you can miss opportunities because of that structure. Exchange traded funds, they can be structured in terms of what's in that fund the exact same way as a mutual fund, but you can trade them throughout the day while the market is open. Hence the name exchange traded funds. So there are a lot of people, because of their tax flexibility, there's less turnover in these funds than mutual funds, which can lead to less taxes if it's a non-qualified account. In terms of their internal expense ratio, in terms of just the flexibility and the long-term diversification, they prefer an exchange traded fund to a mutual fund. Now, what is an S&P 500 exchange traded fund? The S&P 500 is a collection of essentially the 500 most cash-rich companies on the US stock market. So these are your Nvidias, these are your Metas, these are your Apples, your Amazons, and essentially those 500 most cash-rich companies, they comprise the S&P 500. So I say US companies because if you understand that and you want some international exposure, you're not getting that with the S&P 500. It's all domestic stocks. But there are plenty of people out there, people like Warren Buffett, who say, if you want to invest, don't pay anybody, don't worry about anything. All you have to do is put your money in the S&P 500 and just let it do what it does. Now, I actually appreciate the fact that this person in front of you, looking on screen, they have on the screen kind of a pie chart, at least at this point in time, of what stocks are actually driving the performance of the S&P 500. And this is an important point because it's going to drive home my feelings about it being the first place that people should invest. The S&P 500, it makes it sound like if you put $500 into the S&P 500, that they're investing $1 in each of those companies. But that's not actually how it works. The S&P 500 is a weighted index, and the weight is distributed based on how cash rich those companies are, what level of market capitalization they have in the stock marketplace. So what that means is, because some of these companies are just infinitely bigger than others, you could have 5 or 6 companies in the S&P 500 that are actually driving the majority of the performance of that index. So for example, at this point in time, Nvidia is sitting here with 20.4% weight. Apple, 7.3%. So now we're at 27. 34% if you include Amazon. 39% if you include Alphabet. 44% if you include Meta. And what you'll find is, if you look at the top 25 companies in the S&P 500, they are driving probably 70 to 80%, if not more, of the performance of this exchange. So while you are investing technically in 500 companies, you really, in terms of what's driving the performance, are investing in a couple dozen, if even that, companies that are overwhelmingly responsible for their return. Why is this a problem in some scenarios? Well, the first, ethically, there are people who, when you look at some of these companies, they may feel like, oh, if I were choosing my own stocks, I wouldn't want to be invested in Amazon, as an example, or maybe they don't want to invest in Meta. Well, if you invest in the S&P 500, unless you use a tool called direct indexing, which is a conversation for another day, that's not possible. The S&P 500, if it's in the S&P, you're investing in that company. The other reason this can be a concern is if I'm investing my first $1,000 and I'm pretty aggressive, this is not a problem for me, right? Like, I believe in these companies long term. I'm okay with the fact that they're going to rise and fall in a somewhat volatile fashion. I'm in this for the long run, and I'm not going to pay much attention to the day-to-day performance of this account. But let's say that I'm a person who is deathly afraid of the stock market. And I have been avoiding putting money in the market for a very long time. And if I put my money in the market and it doesn't go well, I'm going to be so put off by this that it may be another 5 years before I try this again. I don't know that I would take that person and put them in a portfolio where 80% of that account's performance is heavily dependent on the returns of companies that are all kind of in the same sector. So if this person needs things to go well, and all of a sudden these companies, many of which are interlinked when it comes to things like AI and different corporate contracts, that portion of the market doesn't do well, I could be looking at really wild swings that, while over time may benefit me if I buy and hold and don't pay attention to what comes in the interim, may make me very uncomfortable watching those returns day to day. So the assumption that people should just put their first $1,000 in the S&P 500 no matter what is, to me, a dangerous one, because it doesn't consider factors like risk tolerance and how aggressive or conservative that consumer may be, because there may be something that doesn't have the same boom potential as the S&P 500, but is a better entryway into the market for this particular investor.
This allows me to invest in the top 500 companies in the United States like Nvidia, Apple, Amazon, and Google. Next, I would invest $300 into a growth or technology ETF like QQQM, QQQ, VUG, or VGT.
So they're saying they're going to essentially double down, right? They said they wanted to put it into a tech ETF. And we just talked about the fact that if you look at the S&P 500, overwhelmingly, the companies driving that exchange are already tech companies anyways. So this person is essentially saying, number one, like the amounts that they're saying are very arbitrary, right? Oh, I should put $300 here, $200. Why? Why not just put $1,000 here? Why put $900 here? But they're taking the $200. They're saying essentially, let's double down on this strategy of betting on tech stocks and bet in ones that are even more volatile than the ones that you might find in the S&P 500.
Next, I would invest $200 into a high dividend paying ETF like SCHD, VYM, or SPYD.
So what is a dividend? A dividend is excess profits. So you can have a fund and there are managers of that fund. You can have a stock. And you can have a company that has excess profits during the year. And if you don't want people selling your stock, or you don't want people selling your fund, but they need to raise cash, well, one way that you can provide them their cash without them selling the investment is to give them some of those excess profits. And the way that they do that is by issuing a dividend. Now, a dividend is something where it's like, hey, it's money that you don't have to work to earn, right? You just have to have the investment in and of itself. But not everyone needs stocks that pay a high dividend. I told you that we work with people who earn a significant income. And when you earn a significant income and you just not only generate the taxes that come with selling stocks, buying stocks, and having a capital gain, if you have dividend income as well, if it's an ordinary dividend, that's taxed just like the money that you make at your job. So someone who's in the 32% tax bracket, if they're getting dividend income, they're paying 32 cents on the dollar for the highest portion of their income, but they also, depending on that, could owe net investment income tax. So they're paying an additional 3.8%. So for every dollar in dividend income that they earned, it's generating 35.8% in taxes. And if that's not something that you actually need for your portfolio, there may be other ways to achieve a similar objective that's taxed in a different way. We talked earlier in this episode about a municipal bond. If I have a 3.8% dividend and I am paying 35% in taxes, give me a second to pull up a calculator. Well, that means that even though I got 3.8%, when I factor in taxes, my return was actually 2.47% because I only kept 65% of the return in this scenario. I might be able to find a municipal bond that's generating 3%. And even though 3.8 is higher than 3, the fact that that municipal bond is not taxable means that my after-tax return is actually higher. So this is a scenario where, again, is the concept of a dividend a good idea? Yes. Does it mean that it's the right idea for everyone? No, because there could be some investors out there who can find a similar or better after-tax return by looking at a different tax advantage feature, than a stock that pays a high dividend.
I personally invest in SCHD and the dividend yield is currently 3.8%, which means that I get paid around $1.05 per share per year. Next, I would keep $100 in a money market fund with high interest. There are a lot of great ones out there, but the one that I personally use is SPAXX from Fidelity. If you want to start investing but don't know how to start, you can join my next beginners investing workshop today and tomorrow. Comment invest and I'll send you a link.
This gets to something that I actually talked about. We're going to be on, or I should say, I'm going to be on the Rich and Regular podcast sometime. So we recorded it a couple weeks ago. Really excited about that releasing. But the thing about that podcast that we covered is we talked about like the way that people give financial advice online. And I actually think this is something that it's like a shared responsibility between the financial literacy content creator and the person who is digesting the advice. What I mean by a shared responsibility is this person is obviously selling a service or they are sponsored and they are trying to get more sponsorship revenue by having more people tune into their channel. They clearly have done well. And in pursuit of them getting more people to their cause, they're sharing information about how they've done so well. I have no problem with that. To me, where I encourage people, and it's not even a disrespect to this person, I encourage people to lean more towards education and like teaching a person how to fish than saying, this is the fish, right? Like, this is where you go, this is what you do, this is what you buy. To me, it is far more instructive to tell someone, here's what I look for in a company in which I invest. It doesn't have to be this company. Here's an example, and here's why I chose this company. I prefer that than saying, here's what you should buy, right? Because it takes away the context of what that person actually needs, what else is going on with their portfolio, what's going on with their risk tolerance, right? You know nothing about this person and you're telling them exactly what you use without saying, hey, but you should consider what's going on in your personal situation. Now, here's the thing. Where does that responsibility lie? Does that person have to tell you that every single video? Of course not. It would make no sense at all for a person who chooses individual stocks to cut off themselves at the knees and say, I like this stock, but before you buy this stock, think about the fact that you may not have 3 to 6 months of income set aside in reserves. You may still have credit card debt that you need to consider. It's not their responsibility to do that every single video. It's a shared responsibility of the person watching the video to understand that there are more simple steps that they can take to build a foundation, like building 3 to 6 months of reserves, like putting money in the market, but having it be in something that's a little less risk or less volatile that fits their needs and objectives and where they are financially. So to me, when you're consuming financial advice, I would encourage you to watch videos like that with a grain of salt, not because what the person is saying is wrong or because they're lying, but because it may not be the fit or provide the context that you need to integrate it into your own portfolio. So those are some of the things that I think of when I look at investment advice. It is very rare that I find somebody who is interested in putting money into the market who comes and is doing it for the first time and in my opinion needs to go to single stocks or needs to say, oh, it has to be this or has to be that. In many cases, even when we're talking about things like the S&P 500, I want you to do things like take a risk tolerance questionnaire to figure out how aggressive or conservative you might be. And some of that is not just dictated by what you want to do. Some of it is dictated by the rest of your finances. I have people who will come and they'll just be a month into their savings or a couple of months savings, and they'll start a non-qualified brokerage account and they're investing in the riskiest stocks and positions that a person can find, as compared to saying, hey, I'm not yet in a position to actually be able to lose money. And you always have the possibility of losing with the stock market. But I would be more inclined to have that person say, let's start slow. I'm dipping my toe into the market. And even if I want to be aggressive, I'll be able to be more aggressive once I've built a larger reserve for myself. And that speaks to finances in general. We're rounding up, unless you all have some questions for the evening, with the end of our first Third Thursday. And to me, whether it's taxes, whether it's investment advice, whether it's insurance advice, I would encourage you to go the extra step of asking questions, not just about like the legitimacy of the advice, but ask the question of how does this factor into my financial picture, right? If someone's telling me something to do with taxes, tell them a little bit more about your scenario. Ask them how that applies to you before you take that advice, which may be fringe advice, and may be good advice that's just not relevant to you, and implement it into your strategy. When it comes to investment advice, you should be even more careful. Again, not necessarily because the person is saying something that's inaccurate, but they may be saying something that's accurate and relevant to them that is either not relevant to you because of your risk tolerance, because of your long-term goals, or based on your income, because of your tax situation. And following that advice without asking more questions can be something that can put you in trouble. So I hope you all enjoyed this first Third Thursday. I'll once again share with some of the information that we have coming up that we think is helpful. If you like this, you can subscribe to our channel. You can tune in every third Thursday of the month. And I'll tell you, we're going to be going live more frequently than this. This is just the time that you will know I'll be here, right? But if we hear something financially that we want to hop on, this is something we're going to start doing regularly. Again, next Friday, 11 a.m. Central Standard Time, Black with Equity webinar. If you are someone who has equity compensation at your job, stock options, restricted stock, employee stock purchase plans, employee stock ownership plans, you definitely want to be in the building, because we're not just going to be covering information you need to know from a tax perspective, from an investment perspective, from an insurance perspective. We're also going to be talking about some of the do's and don'ts and taking your questions on how to leverage this for wealth building opportunities. I will see you guys before then, but in terms of the live, you can bet on us being here the next third Thursday of March, and I hope to see you then.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.